Hello. Welcome to Forex Central YouTube channel. Your way to financial freedom. For more information, make sure to check our other videos in this channel. Before you continue, make sure to like, press the subscribe button, and hit the notification bell icon to receive notification updates every time we upload new videos. Claim your Forex trading course tutorial videos for free. Just press like, subscribe, and hit the notification bell. To receive your free Forex courses, please send us your email address at forexcentralofficial@gmail.com with screenshot of your visit in our YouTube channel. We will send it through your email. Thank you. Now let's go for today's video. Forex Central gives special credit to Mohsen Hassan, CEO of MTG, for sharing his expertise and knowledge in Forex trading. Your dedication and commitment to educating others are truly appreciated. We are grateful for your contribution to this Forex Foundation training course.
So we've covered a lot of ground so far, but we're still not ready to start trading yet. So even though we've covered topics like the history of money, the Forex market, quotations, Forex terminology, like pips, lots, leverage, short selling, we talked about brokers, we talked about technical analysis, like charts, trends, candlestick patterns, chart patterns, technical indicators, how we use fundamental analysis and economic calendars, platforms. We're still not ready to place a trade yet because the most important topic of them all is the one we're going to cover now, which is risk management. And if you guys look at any private investment firm and you go online and see what type of jobs or careers they offer, you're going to see a lot of job postings for risk managers. Why? Because this is the most important thing. Managing risk. You are going to see some analyst positions, but you're not going to see, profit-taking management. These companies don't focus on how much money they're making. They focus on how to minimize the risk. Because ultimately, by minimizing risk and minimizing how much money you could lose, you kind of maximize how much money you'll be making in the long run. So this being said, you have to understand that without proper risk management, even if you understand everything else, you will not be successful in trading. So what is risk management exactly? And what is even risk? So risk is basically just an action or an activity that has a potential to go wrong. And when you think about it this way, you'll realize that everything you do in life involves risk, right? If you want to jump off an airplane and skydive, well, there's risk. You could die, right? But you perceive that the risk associated with that activity is so small that it's worth it, right? The probability that it materializes is small and the gain that you get out of it is worth it. If you want to go to, Mexico for vacation, then there's risk. The plane you're on could crash and you could die, but it's a small risk. You perceive it as a small risk and you're willing to take that risk for the outcome or for the benefit. If you get married, there is risk. If you have a kid, there is risk. If you drive to work, there is risk. There's risk in everything. And your job is to see if the risk is worth it or not. And then if you can minimize that risk in any way possible, you have to do so. And this is the objective of this lecture. So risk management is basically going to be the action of figuring out what the risk is and then seeing what you're going to do with it. Now, you have several risk management techniques, 4 of them to be specific. The first one is risk acceptance. And risk acceptance is when you see that there's a risk and you just say, okay, well, you know what? I'm willing to take that risk and I'll take all of it, right? So this is something that we're never going to do in trading, because in trading, when you're just accepting risk, that means that you're willing to buy a currency at this price. And if it goes completely the other way and it goes, to zero, then you're willing to take all that risk and you're willing to lose everything you have, which we're never going to do. Okay. So risk acceptance is never something we're going to do. And an example of this would be basically like looking at USD CAD and saying, you know what, I'm going to buy it at $1.34 and that's it. If it goes down all the way to 40 cents or 30 cents or 20 or 1 cent, I'm still holding. That's it. I accept the risk. We're never going to do that. The second thing is risk avoidance. Risk avoidance is when you see something and you perceive that the risk is too high. And you say, you know what? I'm just not going to partake in this activity because the risk is too high. I'm just not going to do it. And I'll walk away from that. And this is something we will do in trading. Example, when we're looking at the economic calendar and we're seeing that there's an event happening, so we just don't want to have a position throughout this event because it's too much risk. We don't know what's going to happen. We don't want to take that risk. This is something that we'll do. The third risk management technique is the one that's the most popular and the one that will do the most, which is risk limitation. So you perceive that there's a risk and you want to limit the loss if that risk materializes, so you don't lose too much. And this is done through stop losses, which we'll talk about more in the next lecture. But this is really what we're going to be focusing on, is limiting our risk. And in this situation, if we're looking at a currency like USD CAD and we think it's going up and we buy it at 134, then we might say, you know what, if it doesn't go our way and it doesn't go up and it starts going down, well, I'm going to limit my risk and I'm going to take a loss. And I'll take a loss at 1.32 or 1.30 or 1.28 or 29, whatever it is. I'm going to limit my loss. If it goes against me after a certain point, I'm going to take my loss and I'll move on and to another trade. And that's it. That way I limit my loss and the maximum amount I could lose is quantified and I'm okay with it, right? And this is what we're going to be doing the most, okay? The fourth risk management technique is risk transference. Risk transference is basically when you give the risk to somebody else. It's like when you buy insurance for your house. You know that when you buy insurance, you're paying a bit more than what it's actually worth because the company makes money off of you, but you're willing to do that because you're scared that, you lose your house. Now in trading, we don't do that. We don't, you can buy options, you can buy different things to transfer the risk to another party, but then you'll be paying a premium for it and you'll be losing in the long term. When we're trading, we're willing to accept small amounts of risk and get paid for them a bigger amount of money. But if we transfer that risk and we pay for it a bigger amount, then we're not making money in the long term. So again, this is not something we do. The only two things we're going to be doing is going to be risk avoidance and mostly is going to be risk limitation. Okay. And this is what we're going to be looking at in the next lecture. In this lecture, we're going to be talking about stop losses. A stop loss is what you're going to be using to limit your risk on any given trade. So whenever you're getting into a Forex position, example, USD CAD, there's going to be three things that you're going to have to think about. First one is your entry price. Where do I want to get in? For example, here, if we're looking at this channel, you might say, I want to get in somewhere around here. Let's say if the price falls to this zone, I might want to buy somewhere just above this support. Well, if you buy here, where are you going to be getting out? Well, you are going to be either getting out at a profit or at a loss. So what you need to do is send a take profit and put a stop loss. A take profit is going to be higher. So if it goes higher and you make money, you get out at a profit here. A stop loss is going to be lower. So if it falls lower, then you're going to take your loss and move on, right? So what we have to do is, first of all, figure out where we want to take our loss, okay? So whenever you're going into a long position, and I'll put this here, you're going to be buying somewhere, and then you're going to be, let me take this off, and then you're going to be getting out either at a profit somewhere higher, right? You might say, I want to get out here, if it goes up all the way here. But then if it drops, you're going to have a stop that's going to be at a lower amount. And the stop is always going to be, somewhere below a range or a support or somewhere that you feel the currency is going to have a harder time reaching. So your stop loss is always going to be at a lower price than your entry. That's when you're going long, okay? So you have your entry, your stop loss that's lower, and your take profit that's higher. Now, take profit, we don't even consider right now. The only thing we care about in risk management is our stop loss, because that's when we lose money. That's what we care about. It doesn't matter if we make way too much money. It's not the end of the world. But we don't want to lose too much money. That would be the end of the world, okay? And we'll talk about that even more as we go on, because we have a few lectures talking about how we calculate, where we put the stop loss, the quantity that we buy. That's coming up in the next few lectures. Now, if you were shorting, let's say I want to short here. Let me take this. Let's say I want to short, let's just draw a new one. Let's say I want to short if the price goes up here, right? I want to short, okay? If you're shorting, you're betting that the price goes down. So I'm going to use this tool here, the short position. If you short here, you think that the currency is going to go down. So if it goes down, you're going to make money. So you might be, well, you know what? If it goes down here, I'll take my profit. And then your stop price is going to be higher. So you might short at a particular price, and then your stop is going to be higher than that price, because if it goes higher, you're losing. Because you remember, you're shorting, and when you're shorting, you're betting that the currency is going down, right? So if it goes up, you're starting to lose money. So in this case, your stop loss is at a higher price than your entry price, and your take profit is at a lower price, right? So that would be the difference. So depending on which side you're going, if you're long or short, the stop price is going to be at a different price. If you're long, stop price is lower. If you're short, stop loss is higher than your entry price. That being said, knowing that risk management is one of the most important topics in trading, and that risk management basically entails putting stop losses, you understand the importance of setting correct stop losses. Now, where are we going to set those stop losses? What is the position size? So how many lots do we buy based on our account size? These questions we're going to answer in the next few lectures, but now you know that setting stop losses is one of the most important things for you to be successful and to generate income. It's not the actual money that you're going to be making, but it's the amount of money that you're going to limit yourself from losing.